All right, it's streaming. Woo-hoo! Okay. This is awesome. Awesome. So hello, everyone. As promised, a few of you have asked about a cost segregation expert coming in to talk specifically about the impact that it can have on short-term rentals. So I bring you tonight the infamous, the one and only Yona Wise. He is here with us inside of our inner circle. So you get to see some of the behind the scenes of what goes on inside of LSA, but we will have the opportunity to learn a little bit more about cost segregation, as well as have our questions answered. So Yona, I'm going to figure out how to pin you as we go along, but yeah, I would love for you to go ahead and introduce yourself and give an intro on cost seg. And guys, feel free to place a 1 in the chat and we're going to go through and I'll say so-and-so, ask your question and so on and so forth. And meanwhile, I'm going to also look at my chat. For those of you who are joining us online, we're streaming on LinkedIn, YouTube, and a few in our Facebook groups as well. Feel free to say hello. Let me know that you can hear me. I want to see some heart emojis, some fire emojis. You'll hear my voice crack a little bit. I am a bit under the weather, but I so wanted to be here with you tonight. I did not want to miss this at all. So feel free to say hello in the chat and let's go ahead and dive right in. Yona, what's the big deal with cost segregation studies? And why am I telling everyone you have to buy a house right now to get your 100%? What is that all about?
Okay, so first of all, thank you so much, Rachel, for having me. Obviously, this is a really important topic any time of the year, but especially this time of year. And you're so gracious to do this, even though being under the weather, I definitely know how that feels. And I give you a lot of compliments for doing that. My name's Yona Weiss. If you guys don't know me, I'm not sure how infamous I am. I don't have a police record as far as I know. And, but it's a great compliment to be known as the cost segregation expert. I work for the largest national company, Madison Specs. We do over 5,000 cost segregations a year all across the country, every single asset class. But this has gotten a lot of steam over the past couple of years, specifically for short-term rentals. And I think one of the main reasons, and I'm sure you guys have spoken with Ryan Backey and with, I saw last week you had Amanda Han on the show, or the week before, and you guys are just doing
Tom Costelli, real estate CPAs, all of them. Yes,
you're getting all the experts on, talking about taxes, and everyone has talked about the real estate professional status, I'm sure, but also the specific, they call it a loophole with the short-term rentals, but really it's a specific strategy that you don't need to be a real estate professional in order to take advantage of the benefits of cost segregation. And so the main benefits of cost segregation, I'll give a brief background for those of you who are watching this that may not know what it is, and just to understand it so we're all on the same page. Although, even though we're streaming on live on many platforms, those of you who are in the Zoom, I always love to gauge kind of the audience here. Where are you guys at? I know a couple of you, Jackie mentioned before, she's done cost segs multiple times. I'd love to hear from the rest of you. If you've ever done a cost segregation before, just put a 1 in the chat. If you yourself have actually done it.
Take off those socks.
Yeah, everyone's excited about cost segregation today. I am too. So guys, put a 1 if you guys have done cost seg before. Put a 2 if really this is the first time you're really hearing about it, or this is something that you have wanted to learn about because, hey, maybe you want to get this done on your property, or you're looking to buy a property, and this is going to be a complementary strategy, as Rachel mentioned before, with your taxes. There you go. I'm just trying to put in a 2. Okay. A lot of people. Great to see you guys here. Great to see 7 so far. Oh, wow. Kimberly, you are very active, and that's awesome to see, because once you've done it, you notice that it actually makes a big difference. And I'm going to talk about why this is so important. So first of all, I'm going to discuss what it is, and then we'll talk about why this is so important, especially specifically to short-term rentals. I'm sure the others have talked about it, and then I'll be happy to answer your specific questions after that. So cost segregation is really just a fancy word for accelerated depreciation. Anytime you buy a property, besides for your personal residence, and we'll get into, if it's a vacation rental under your name, we'll talk about that also. But just besides for your primary residence, you're able to take this tax deduction called depreciation. Now, it doesn't mean what it sounds like, that it's like going down in value. It's just a borrowed term. It's a tax deduction that allows you to write off the entire value of your property, okay, excluding land, because land doesn't depreciate, but the building and all the property that's on the land does. And so you're able to write that entire amount off. Just you can't do it all at once. So for residential properties, you have to split that up over a 27.5-year period. And for commercial, including short-term rentals, and this is where a lot of people get confused here, short-term rentals are treated like transitory rentals, and therefore they're like hotels from a tax perspective. And so therefore they're treated on a 39-year schedule, similar to commercial properties. Now, a lot of people get confused when it comes to depreciation. Just want to clear it up. It's pretty simple. Just keep it simple. You're able to write off the total value. You just take it a little bit every single year. That's called your depreciation deduction. What cost segregation does is just like the name sounds. We are segregating the cost, that purchase price. We're just breaking it up into different categories. Okay, there are certain components of the property, which is actually a much better name for it, component depreciation. So what we're doing is depreciating the individual components. Some things like furniture or appliances or cabinets or carpeting or flooring, all that stuff actually depreciates on a 5-year schedule. And so by identifying what those components are and the value, we're able to depreciate those items faster. And so it's simple, component depreciation. That's all it is. Now, the way to do this is you need an engineering. The IRS requires, and again, all this stuff this is not some like outside loophole or anything like that. We want to take this directly. This is straight from the tax code. This is something directly from the IRS, and they require it for the highest level of cost segregation. What's called the quality cost segregation report needs to be completed by someone who has training in engineering and construction engineering, which means what we're doing is we're sending our engineers to the property and identifying all these things that are in there and just taking pictures and videos, et cetera, to make sure to verify what the property actually consists of, and once we identify what's inside and what's outside, also landscaping, pavement, right? You have a swimming pool, a deck, a patio, all those things can depreciate at a faster rate. Once you've been able to identify what those things are and component depreciated, we can now take those deductions at a faster rate. So just to backtrack, why this is so important, because you're able to take from this pool of potential deductions, instead of just a little bit every year for 39 years, you may not hold the property that long. You can take that pool of potential deductions and take a big chunk of it up front. Okay, so it's allowing you to create more cash flow by having more tax deductions. The more tax deductions you have, the lower your taxable income is, the less taxes you pay, the more you have to reinvest. And simply put, that's really what it is in a nutshell.
Oh, I love that. Oh my goodness. So we can go ahead and take a look at some of the comments in the chat. I see Pam stated that this would be something she would be interested in. So a lot of twos in here. Yona, Shoshana has a 2. Yuri and Nina, they just purchased. So I'm super excited for them. They have a 2 as well. Ryan and Hasina, they have a 2 as well. They're looking to purchase before the end of the year. So TikTok, right? There's Nina, she has a 2. So that's really awesome. So Yona, tell us, like, we're 5. When you say the more money that we can write off in our taxes, but the more we have to invest, what does that look like for the day-to-day hardworking medical professional who say they're generating an average? We have a wide variety here. We have from nurse executives when it comes to the medicine side to, radiologists and surgeons who are making anywhere from $80,000 a year to, upwards of $300,000 or $400,000 a year. What does that do to those incomes, and how does that impact them from a numerical standpoint?
So I want to just kind of break down how depreciation works from a numerical standpoint, like you're saying, from a tax perspective, because it changes based on a few important factors. Okay, so simply put, how depreciation works is it is considered a passive deduction. And you may have heard this before from the previous speakers, but that passive deduction goes to offset passive income. So the IRS treats any rental income, so you have rental properties, whether it's long-term, short-term, doesn't matter, it's all considered Schedule E rental income. Okay, this is really important. And that's where depreciation hits. So if you make $400,000 from your W-2 or 80,000 or whatever that is, and also, $30,000 from your short-term rental or rentals, they're treated in separate categories. Okay, so the depreciation can be used against those rental income. Okay, because that's considered passive activity, and these passive deductions can knock down and reduce that passive activity. So you can completely wipe out your passive activity income, but in order to then carry that over to also offset or lower your W-2 income, there are a couple important factors. Right? Not everyone can do this. And this is why I'm glad you brought this question up, because we're all thinking, oh, cost segregation is so great. But in the end of the day, it may not necessarily be so great. So one important factor is this short-term loophole, as they've called it, but the passive activity rules specifically with regard to short-term rentals are such that you need to have what's called material participation, which means if you have a property manager, there's no way that you can also use these depreciation deductions to offset your W-2 income. You need to have personal time being spent either 500 hours a year on across all your properties or 100 hours a year plus more time than anyone else. And so I think that's the path that most people, especially if you just have one property, it's very likely in the setting up process, in the dealing with vendors and the cleaning people and just dealing with guests in general, you're going to have more than 100 hours in a given year, right? More time than anyone else just means that you're actually spending more time than, let's say, your cleaners, or if you have a management person or something like that, which is why the manager, if you have a property manager, you can't really do that. Now, once you do hit this, what's called the material participation threshold, and this is really important, and the average stay is less than 7 days, okay? So midterm rentals are not going to really help with this. Then you can use these passive deductions to offset your active income, your W-2 income as well. So let me illustrate with just some basic numbers. And I think some others who have had cost segregation done can share these numbers as well. But let's say you buy a property for $500,000, right? $500,000 property. And you put it into a rental, short-term rental. With the cost segregation, on average, we're seeing for short-term rentals, let's say about 25%. Now, after we've allocated some portion to land, I'm just using a calculator over here because I can't do this all in my head per se. But let's say you didn't do cost segregation. That $500,000 property would generate about approximately $10,000 of depreciation deduction. Okay, simply put, $10,000 depreciation means that if you make $30,000 from your rental, you can reduce that by $10,000. You're only going to be paying tax on the remaining $20,000 of net income. However, if you do a cost segregation on that same property, instead of that $10,000 income, and let's just say you're taking off 10% for land, like in the Smoky Mountains, it's pretty common, 10% for land, and you're left with $450,000 of taxable basis. That's the amount that you can depreciate. $450,000. What's 25% of that? Just using my calculator over here. That's about $112,500. Okay, so that's probably what you're going to get on average for cost segregation on your property. What does that mean? That means that's what we call bonus depreciation deduction. That means you have the option to take that full deduction in the first year. You're going to reduce your income from your passive income entirely. And then any of those extra losses, if you meet these material participation requirements, you can then reduce your W-2 income by that amount as well. So multiply this if you have 2 properties, 3 properties, etc. Like who was it, Kimberly, that said before she had 7 properties. That's what you're doing. You're going to reduce your taxable income and hopefully to zero. And this is a way to help you scale really more than anything else.
That is so good. So guys, for those of you who are in the room, we have over 18 participants in the room right now, Yona. This is your opportunity to ask about your specific situations, because I know we have entrepreneurs as well. Although, I started with, we have a lot of medical professionals, but we have entrepreneurs as well. We have those who are just full-time investors. We have those who are realtors. I would love for you to chime in. What are your specific questions? Because once Yona leaves us tonight, we definitely will have a way to contact them. But when people come to me and ask me these long, drawn-out questions, and then they drop regulations in it, I look at them like, I'm not the one. I'm so not the one. I appreciate all of these regulatory things you're sharing with me, but my full-time job was a pharmacist. And I bring in someone whose full-time work is cost segregation. This is what he does full-time. You are now in the room, so please feel free to chime in and ask your question. I see some things going on in the chat. I want to pause right now to take advantage, allow the members in here to take advantage. So I'm looking to buy before the end of the year. Yeah, Elena, that was her comment. Kimberly is chiming in. She says, Elena, do it. It's the last year of 100% bonus depreciation. It goes down to 80% next year. Yona, this is why I just spent the last 4 weeks, imagine 4 whole weeks talking about taxes. Like, if you know anything about me, this is not what I want to talk about. I'd rather talk about how do we zhuzh up our property with cute things, taxes. And this is why, because friends don't let friends miss out. I know someone's going to say, I never heard about this bonus depreciation on December the 25th. I'm like, what? It's the end of the year. You've never heard. I've been talking about it all year. So let's talk. I think it's let's take a pause and talk about what Kimberly just mentioned there. The legislation that allows us to go 100% this year. What is it going to be the next year? What is it going to be the following year?
Right. So currently there's something in the books, in the law, called 100% bonus depreciation. What that means is once you've done a cost segregation study and you've allocated those components to faster schedules, remember, the majority of the depreciation is going to be in the structure, in the structural components of the property, like the walls, the roof, the doors, windows, floor, foundation, right? Infrastructure. That's where the majority of the value is the properties. But what we're accelerating the depreciation into 5-year personal property categories or 15-year land improvements is about, let's say 20 to 30%. I say 25% on average. Of that, you have the option to take 100% of those deductions in the first year. That's called bonus depreciation. It's not anything extra. Okay, like bonus sounds like something extra you're getting. It's not. It's just you have the option to take all those deductions upfront in the first year. Before this came about and this law came into being in 2017 with the Tax Cuts and Jobs Act and was set in the books to start to phase out. Okay, so 2022 is the last year, as Kimberly mentioned, it's the last year that you can take 100% of those deductions this year. Okay, if you buy a property or you bought a property last year, whatever, and you want to place it in service or you want to take cost segregation, you can still do that this year. It doesn't mean you have to do the cost seg by the end of the year. It just means you just have to have placed the property in service as a rental by the end of the year. Okay. As long as you get it done before you file your taxes. And many people file extension. So you have till this time next year. Okay. However, next year, it's going to start to phase out by 20% each year. As she mentioned, down by 20% to 80% bonus. That means you can take 80% of those accelerated deductions in 2023, and the remaining 20% you can still take at those faster rates of 5 and 15-year schedule. But so you're not losing out entirely. Again, it's just going to revert back to how cost seg was before there was bonus depreciation a few years ago. And then following year 60, 40, 20 until it's phased out. So that's simply put how cost segregation and the bonus depreciation is going to work.
Can I ask a question?
Yeah, please do.
Just to clarify, if I bought a property on 2022 and I put it on service on 2022, can I do the cost seg on 2023?
You can, yeah, absolutely. So you have the option to use this when it's most beneficial to you. Okay, you do not need to do the cost segregation in the first year that you file taxes on it. Okay? Even if you had a property you've owned for a few years, you can still now do cost segregation, even though you just filed what's called straight line regular depreciation. So, Shoshana, if I think I'm understanding your question, you just want to file regular in 2022 and not take the bonus depreciation, and then in 2023 do the cost segregation. Is that what you're asking?
Yeah, because I think I'm like I don't know if I'm putting this right, but I might have utilized like every possible deduction that I already have. So I don't need it for 2022.
Right, exactly. And so that's exactly the point. It's a strategy. When you need these deductions, that's when it's best time to use it. If you just do cost segregation and you don't need it, all that will do is just create a passive loss that will carry forward, meaning you're not going to lose it out. But if you can't utilize it, it doesn't necessarily make sense to pay to get something done when you can't actually use it.
Okay, thank you.
Absolutely.
That is a great question. Yeah.
I have a question too.
Yeah.
Yes, hi, this
Hi,
is Hugh.
Yuri.
Hi,
I see you now.
I'm actually at the place and trying to renovate some stuff myself.
Ooh, so Yuri just closed on a house, him and his beautiful wife, Nina. They just closed on a house in the Poconos. So super excited about that for him. So massive congratulations to you guys. So you're there now, Yuri?
Yeah, I'm here and working with the plumbers and installers. So we're doing like some small renovation stuff here.
Okay, all things that will need a cost segregation study.
Right, but my question is this: we have to be live as a short-term rental at least a day, right, to be able to do that cost segregation?
So technically, yes, you need to have it placed in service, be live in order to take depreciation. Whether or not, I don't know if you heard what we were talking about before about the rules of material participation and being able to use those deductions. Well, if you don't spend 100 hours during the year, and then you won't necessarily be able to benefit unless you are, we didn't discuss this yet, but unless you're a real estate professional. So if either you or your spouse are what's called a real estate professional, you are able to use these deductions against your active income as well. So yes, you can take the cost segregation, but those losses will not be able to be used against your ordinary active income unless you qualify for the material participation hours.
So material participation only means after we're going live. Whatever after the purchase, before we're going live. If I do something here, it's not considered as material participation.
No. So if you, anytime after you close, essentially any hours being put in. So yeah, if you're working on, doing the renovations, if you're working on setting it up, all those hours will count towards that.
Okay.
But again, yes, you're absolutely right about having it be live and actually be rented before the end of the year.
Okay. Thank you.
Great question. Okay, Annette is asking, is there a cutoff date in which the property needs to be in service to receive the tax advantage? So I know you spoke a little bit about that, Yona, but please feel free to expound upon it.
Yeah, exactly like you just asked. When depreciation begins on a property when you place it in service, and that just means that it's ready to be rented or you put it online, something like that. So the cutoff date for every single year is December 31st. So for you to take advantage of cost segregation for or depreciation in general for your 2022 taxes, you need to have the property in service before December 31st.
Awesome. Okay, so Kimberly says, yes, my question is how exactly will the bonus depreciation be going away over the next several years? And so the bonus is going away, the ability to accelerate it. But is it true, Yona, and this may be a different question or it may be the same, is it true, Yona, that it's still there, the ability to depreciate is still there, but it's going to have that typical longevity of 5, 7, 30 years or whatever it is at this point?
Yes, that's absolutely right. And I think I answered this briefly before, but it's going to start to phase out the bonus depreciation, but you can still take the cost segregation lives. And this is similar, by the way, all that we're talking about here about cost segregation and reducing your income tax liability, it is income tax. So not to be confused. Some people often question me if this has to do with your property taxes. Can you lower your property tax? I get people in New York like calling me all the time. Oh, you can help me lower my property taxes because it's so high in New York. But this is on a federal level. And I should mention that there are many states that have decoupled from the 100% bonus depreciation, meaning on the federal level, you can take the 100% bonus. On a state level, on your state taxes, you'll still have to file the regular cost segregation method of 5, 7, 15, and then 39 year. So that's a big distinction. And that will still be the way you can depreciate it even after bonus depreciation is phased out.
still beneficial, right? I mean, it's better than having it all either over 27.5 versus 39 years. It's not as
100%.
good as the 100%, but still worth
Exactly.
doing a cost seg.
Exactly. And cost segregation has been around for decades. And so people were doing it, before the bonus depreciation. I think it just gave such a huge, influx of investors coming in and using it more than there ever has been over the past few years. But yeah, certainly absolutely correct. I believe it will still be beneficial.
Awesome. So with that being said, I want to do a round robin and ask who has purchased a property this year, who is not going to do a cost seg study. Would love to get some ideas as to why. I see Shoshana, and Shoshana has her strategy nailed down. She's done a number of transactions this year with real estate, so totally makes sense. And the reason I'm asking is I just really want to demystify cost segregation study and normalize it as a part of your conversation and your wealth strategy, because a lot of times we think the levers that we need to pull are the grinding of increasing occupancy, but I'm more about how do we leverage and pull other levers within our portfolio and pull other strategies and tactics within our portfolio to expand our wealth. It doesn't have to be the nightly stay only. So taxes and cost segregation studies are levers that really move the mountains. And so I saw you unmuted. Kim, did you want to co-sign on that, or did you have other a contrarian? Feel free to.
No, I mean, I love
counter me.
cost seg. It's saved us multiple six figures of taxes. But I think, cost segs can be different based on what type of property you buy and where you buy it. Land basis is different in different areas. And so if you buy in a high cost of land area, you're not going to get quite as much of bang for your buck from the cost seg because you can't depreciate the land. Our strategy this year is in order to take as much advantage of the 100% still in effect and we wanted a second home, vacation home in one of our dream locations, but was to buy a condo in a vacation destination that short-term rentals have been in place for decades. So we didn't have to worry about the rules and regulations and HOA issues. There's an HOA, but they allow short-term rentals. But with a condo, there's no land to take away, right? So you're working with the entire purchase price of your condo when it comes to cost segregation. So that really was able to make us be able to maximize how much we were able to get out of that cost segregation and bonus depreciation to offset our taxes for this year or offset our other income. So other things, there's so many different things to think about as far as what your goals are for your tax strategies and your investment strategies and where you want to buy properties and whatnot.
Yeah,
absolutely. Great points.
So guys, what Kim just said, I don't know if you realize, she just dropped gold in her comment there. And I just want to revisit it for those of us who are sitting in the back, because I'm not usually a condo girl, but what she just said is the reason why I would ever purchase a condo, really. So in summary, remember when Yona said when he goes in and his team goes in to do the cost seg study, the first thing he does is deducts the price or the value of the land. Say you purchase a home for $400,000, he's going to minus the land. Say the land is worth $100,000 because land cannot depreciate. Okay, so now he has $300,000 to contend with to figure out, what can be depreciated within the $300,000. What Kim just stated was that there's no land to deduct because she purchased a condo. Let me say that again. There is no land to deduct because she purchased a condo. Right? I'm just going to let that marinate right there. For those of you who own townhouses, wink, wink, condos, wink, wink, there's no land to deduct. Okay? That's all I got to say.
I'm not saying it's been easy with the HOA. I mean, they have like
Of
made it really
course.
difficult for us to get our remodel done. We're finally almost done with that. So it's taken like twice as long as we thought. But yeah, so pluses and minuses of HOAs and condos. But what's the one a plus?
Yeah. Yeah, I'm not usually I'm not a condo girl, but when I learned that earlier this year, I was like, okay. So that puts one ticker in the box. If you're looking, you know, pluses and minus, this is definitely something to take into consideration if you're looking at that. I'm not saying go out and buy a condo. So thank you for the disclaimer, Kim, but we got to know all of the aspects of what we're dealing with. And I think that's really exciting. That's why we're here today. All right. So I'm going to be quiet. So for those of you who are still feeling a little bit intimidated by a cost seg study, feel free to unmute your mic. This is your opportunity to ask your question right now. And I know we're going to interview Quay, who is going to give her version, you know, from an end user, her perspective in about 15 minutes or so. So this is your opportunity. And I'm looking in the chat.
I do have a question.
Go for it.
When you do, hi guys. So when you go back to sell, so say for instance, you did a cost seg and you go to sell and you know you recapture. How does that work on the sale side? Or do we just need to do 1031 exchange and just forget about the taxes? What's the best strategy?
Excellent question. So a couple of things about recapture tax. Okay. First of all, a lot of people think recapture means I pay back the depreciation. That's not what it means. It means you're going to be subject to a tax on the amount of depreciation taken during the life of ownership. Now, if you have more losses than income, which hopefully that's not the case, but you'll have those carry forward losses. Those losses will be released at the time of sale and can help to reduce that taxable income and that gain. So the recapture tax essentially is a capital gain. Okay. It's called an unrealized gain, which means just like on a capital gain where you've made profit on the sale from the purchase to the sale, you can be taxed on that amount. So too, how depreciation recapture works is the amount of money you've taken for depreciation, you're going to be taxed on that gain of how much you've amounted. So a couple quick strategies of how to reduce that on the sale, because it doesn't mean, number one, doesn't mean that you're going to pay back all those taxes or all the depreciation. And number two, doesn't mean that you are even going to be, you're subject to the tax, but doesn't mean you actually have to pay it with some other strategies. So a couple of things. Number one, in order to reduce it as much as possible, you're going to want to stay in the real estate acquisition mode, which means, either number one, you can do a 1031 exchange, like you had mentioned, which is a strategy to buy one property by exchanging it from the sold property, file some forms. It's really complicated in terms of the timing to do that, but nevertheless, you can do that. That defers your capital gain tax and that recapture tax. Second strategy is just buy another property in the year that you sell. Maybe you don't want to do a 1031 exchange. You don't want to be limited to the timeframes. You don't necessarily have to want to go through those hoops. You can use the losses from cost segregation in the year of you buy a new property to offset the gain from the sale of another property. Okay, so that's another strategy there. There's also something called partial asset disposition. And without getting too complicated here, once you've done a cost segregation study and already have allocated certain components of the property to a 5-year schedule, well, once you've held the property for 5 years, essentially you've assigned there's no value left to any of those components. Okay. So for example, let's say you assigned, $10,000 to the appliances and you held the property for 5 years. Normally you would be taxed on the amount of depreciation. But if you file this extra form called partial asset disposition and claim no value for those appliances because I've already done a cost seg and applied, assigned the value to those specific components, I can now write that off essentially from my taxes and not have to pay recapture on that amount. So there are a few of these strategies. Again, it's not straightforward. And if you're just kind of going through the motions and don't really plan accordingly and strategize with your tax planner, then you may miss out on some of these different rules and strategies.
One more question. Can you do I don't know if one has to do with the other, but if you do a 1031 exchange, and does it affect anything with the cost seg?
So it shouldn't. Well, let's put it this way. When you do a 1031 exchange, your tax basis carries over into the new property, which means when you buy a new property, right, you subtract from land, and then the purchase price essentially minus land is your new depreciable basis, the amount you can spread over 39 year or break down into cost segregation. But when you do a 1031 exchange, however much depreciation you've already taken from property A is now going to be deducted, right? That's that unrealized gain that carries over into the new property. And so unless you add more money into the new property, let's say, you sold a property for 500,000, bought a new property for $100 million. And so you put more capital, even if it's finance capital, right? From a bank, put more money into that new money can be fully depreciated, but the original purchase price that's carried over, again, you're going to have to subtract that unrealized gain from the new purchase.
Okay, thank you.
Yeah. And I do want to kind of go back to something Kimberly was saying. You mentioned about the condos, and just make a comment about the land, right? That's totally accurate. Most condos, you will not have any land allocation, which means you're going to be working with the full purchase price. However, on the flip side, like you said, there are some disadvantages working with HOA, et cetera. But another thing specifically to the cost seg is that a large component that can be depreciated on an accelerated basis is the land improvements. So not the land per se, but what's on top of the land. So if you have a big property where you have landscaping, you'll have pavement, you'll have even a swimming pool, or, let's say a gazebo or whatever it is, all of those components that you own, those are 15-year depreciable basis. And on many properties can be a significant portion. I mean, I just did a property this week down in Destin in Florida. And it was like 20% of the property was allocated to the land improvements. Okay. So that's a huge amount. Okay. Which you're going to be missing out if you have a condo and you just have basically walls in. Now, there are different types of condos where you may actually own some of the land improvements as well. You may have a portion of ownership in that, but just to kind of, there is, on one advantage, but it may be canceled out by the fact that you may not have the land improvements. So it may just even out in the end.
So are you saying, Yona, then that if you're adding outdoor amenities, those things can be leveraged for your cost segregation study?
Yeah, those components are depreciable on a faster basis and can be eligible for bonus depreciation. So pavement, concrete, gravel, bollards, whatever it is, fencing, like I mentioned, swimming pool, patio decks, all that stuff.
So Yona, I can get that swimming pool then after all that I was trying So I know a couple of people within the community are building a property. So how do you time things? Like, what is the best way to get the best bang for your buck? Because we see that the timeline has extended. I'm victim to that as well. So how do we leverage cost seg? What would you do, Yona, if you were in our position where we were hoping to be live before December, but we're not now? Like, I'm looking for other deals simultaneously to go live. Is that my only option for this year, or should I just throw some RVs in an Airstream and do a glamping experience? In the interim, look, I stay up all night trying to figure out how to make my dreams come true. What would you do, Yona?
Wow, it's a loaded question. I don't know. It's a hard thing to say. Everyone's got their own thing, but you're absolutely right. In terms of a new construction, a lot of the stuff gets delayed. It's not placed in service, not ready. Unfortunately, depreciation only begins once the property is placed in service. So once the construction's completed. Are you going to have other options? Like you said, can you throw something in there and just get it ready to go? Maybe. Would that help with the whole property? I'm not sure. I actually don't know, honestly, if you could place in service by doing something like that, but just kind of camp out, that's not a bad idea, but I'm not sure because the property's not yet completed. Sorry.
Yeah, that's where I was headed as well. So I don't see any additional questions, but I did want to ask, so Yona, this came about primarily, from my knowledge, with being a Bigger Pockets binge listener, cost segregation study, only those who were in multifamily, had this opportunity. And I'm just so thrilled that short-term rentals, which is I'm a big proponent for, which is a lifestyle investment. Let's buy things that we can also enjoy, but are there other sectors, other businesses that are leveraging these types of strategies? I know vehicles are getting purchased towards the end of the year to leverage some of that. What are some other strategies and tactics that you have seen used, not necessarily cost segregation or bonus depreciation, but something similar that those in our community might want to look into?
Yeah, absolutely. So, I mean, just to clarify that point, cost segregation can be used on any type of property. So it's not limited to multifamily or short-term rentals or anything. If you have storage or office or industrial, just not your primary residence. But yeah, you're absolutely right. Buying vehicles, there's certain ones that have higher deductions that you can write off. There's something called 179 deduction that allows you to write off vehicles or other equipment that you're buying. If you need any equipment, I know someone who has a very luxurious rental, short-term rental, and has bought lawn mowing equipment and these kind of things that go on the property, complete 179 deduction write-off. So that equipment can be written off. Again, you have to spend money in order to take those deductions. So is it a benefit? Yes, it still is a business deduction. One thing that I would say is my favorite type of deduction is charity. I mean, just simply put, like, guys, there are so many people less fortunate than us. Wherever you are in life, there's always someone who's not as fortunate as you are. And so to me, that's my number one thing for write-offs is I give a huge amount of income away, and that just reduces my taxable income. So that's an easy one.
Oh, I love that. The contribution pillar. I fully support that as well. So this is good stuff. I know that Kim just dropped off. She said good stuff, guys. Last chance to get your questions answered. And Yona, I just cannot tell you how appreciative I am to bring you into our community, because you, sir, have the heart of a teacher. You take your time, you share the information. So I so appreciate that. As I'm rallying the final questions, if there are any, feel free to let us know. How do we best get in touch with you if we want to work with Madison Specs, or if we have more questions, if we want to know whether or not the asset that we have, if it's a good idea for us to move forward with cost seg? Is that something we can do? We can reach out to you and see.
Yeah, sure. You can reach out to me. I'm on Facebook. I'm on LinkedIn. It's my most active platform there. You can find me on Instagram or yonaweiss.com. You can also go to our company's website, Madison Specs. And we always like to run a free upfront feasibility analysis so you can see what the potential numbers would be if you did a cost segregation. And I'm happy to jump on a call if anyone has any other questions, although I will be honest, my calendar is booked out for like the next month or so. But either way, happy to connect.
Awesome. Awesome. And guys, if you have any questions that you want to drop within the chat below, those of you who are watching on social, feel free to do so. And me or someone on my team, rather, my calendar is quite booked as well, Yona. We will make sure that that question gets to Yona and his team. And so just bear with us, because we know everyone's wanting to get their situation ironed out before the end of the year. So thank you for your patience. So Yona, again, thank you. I'm going to look in the chat one last time for questions. And I think my chat disappeared on me. Okay, there it is. Okay, just a whole lot of gratitude. Kim says thank you. Nina says thank you. Ryan says new question listed above. Okay, so let me see. Oh, I see it, Ryan. Wonderful. Okay, Ryan says, we built a carriage home 2 years ago as a place for my mother-in-law to stay, but she's going to be spending more time in NOLA this next year. Good for her. We're wondering if we could set it up as a short-term rental by the end of the year and then apply for cost segregation study after meeting material participation. Would it be worth it? The carriage house is a 1-1 and approximately $100,000. That is a great question, Ryan. What do you think? What say you, Yona?
Well, typically, I mean, you certainly can get it done. I would say for what we call a quality cost segregation study, an engineer-based study, the value of the property, the amount built really does matter because the amount that you're going to get in return is proportionate to the actual cost basis. So if you spent $100,000 to build it, that it's a great investment, but the amount you'll get in return from the cost seg may be very little. And so to get a full cost segregation study done may just not be worth it. However, I will say there are, some people have talked about this in the past. There are what they call these desktop or these online kind of software cost segregations, which are kind of, they're not fully recognized in terms of audit proof, but I know some accountants, I know Tom Castelli was here last week. He recommends them for certain smaller properties. So it is something that you might want to look into from that respect.
Awesome. So full on audit free, or I guess audit
audit proof.
Free.
I mean, it's audit protected. Yeah.
What's the range for something like that versus a desktop, just so that we can get the wheels turning?
It's my basic like rule of thumb is anything over $200,000 purchase price or cost basis is definitely worth looking into. Once you're higher than that, the more the value is, the more it makes sense, because again, the cost is going to be the same to get it done regardless of the price, which is really, really important to remember. We're not charging you based on the contingent to your tax savings or anything like that. It's one flat fee. If you buy a $200,000 house or a $2 million house, it's going to be the same cost. So, but the value and the returns or the benefit is going to be significantly different, obviously, because it's proportionate.
Okay, awesome. All right, so we're going to jump off. I do have to meet up with Quay, but I did have a quick question that came in through YouTube, and I don't want to miss out on it. Someone says they're looking to transition their primary home into a short-term rental. Can they do a cost seg on that?
Yes, absolutely. Two important things to note when you're doing that. Number one is it's going to be based on your original purchase price whenever you buy it as a primary home, and it's going to begin when you place it in service. So your depreciation is going to begin when you place it in service. And so those are the two important factors you need to know there.
And one more thing, if I quit claim deed my primary home to my LLC, then do an STR, can I do a cost seg with bonus depreciation?
Yeah, it doesn't matter, quit claim deed or, turning to LLC, as long as it's a rental property, if it's in your personal name or, et cetera, same thing, you can do a cost seg.
Wonderful, wonderful. All great questions, guys. Again, thank you. Thank you. Massive thank you, Yona. Guys, if you have any other additional questions, he is the professional to talk to. Do not ask me anything about cost seg studies. I'm just an end user, just doing my best with it, but Yona is the professional. So definitely tap in with him, connect with him and his team, and they will have your questions answered. Have a good night. As you guys know, in the community, I love you to the moon and back. We'll see you next week. Bye-bye for now.